Hopefully everybody can hear me out there. Welcome to Freightonomics, the podcast / show, depending on how you're listening, watching, where we combine that macroeconomic environment with the transportation, global supply chain stuff so you can get the information you need for whatever it is that you want to do with your life. And I'm here with Chief Economist Anthony Smith this week. And this week's show, before we let Anthony do his thing, it's going to be about the transitioning market and some of the data signals that we're seeing around it. Isn't that right, Anthony?
That's right. The sky is falling.
Oh, no.
Just kidding. It's not falling, but it could be concerning if you look at some of the data points. And so that's, like as Zach said, what this show is going to be about, some of the transitional data points that we're looking at right now and what we're really seeing in the underlying trends. So excited to jump into that. Of course, as Zach mentioned, this is Freightonomics. And if you see me looking down, I promise I'm not being that rude. I'm only being a little bit rude. I'm also looking on LinkedIn. So if you're watching right now, we're live streaming. Just so happens to be 12 Eastern Standard Time on a Thursday. Chances are we're live right now. So if you want to jump into the conversation, feel free to jump into that chat. If you want to get the full experience, you can go to live or tv.freightwaves.com and get into our Freightwaves ecosystem and also download our app and all things amazing. So without further ado, Zach,
let's jump into it. We've been adjusting to this 26-minute show format for a few weeks, and it still kind of sneaks up on us. So let's get rolling with what we've got. So let's set the table real quick for the people, especially, there's always some first-timers out there. Over the last 18 months, I don't know if you've noticed, but we've had a little bit of some disruption. COVID pandemic type environment here has really broken a lot of traditional metrics, and also changed a lot of behaviors in the world, especially involving transportation and global supply chain management. And transportation costs have been inflating well before the inflationary pressure for the rest of the commodities environment and things like that were taking place, because transportation, of course, got scarce because this huge surge or influx of consumer demand, really unexpected. Nobody budgeted for it. And of course, production shortfalls due to COVID, et cetera, really made things a lot more difficult. So you've got also this subsidizing of demand, where we had all those stimulus packages. Mm-hmm. And then you had supply chain limitations or supply limitations at the same time. So the natural outcome, you're the economist.
Yeah.
What happens when you have demand that's
exceeding supply,
and also you inject more money into that demand?
Yeah, so there's going to be substantial amounts of inflation, because now you have more resources to buy the goods that you want, and then you have all these other assets that you might be chasing because you don't know, hey, I have all these funds. What else am I going to put these funds towards? Maybe crypto? Remember the run in crypto? That was a big thing. You saw a run up in GameStop. So
NFTs, things that don't exist. People had so much money, they were literally shoving it into imaginary friends. I guess this is where we get into this type of uneasy environment, where you and I were talking about inflation last January, a year before it even happened in the level of significance that we're seeing today, as being like a big risky bubble, because that's what we're talking about today. Is are we seeing bubbles start to show some signs of softening or weakening, and maybe eventually popping, especially in the transportation sector. So we've got a couple of topical stories that I want to lead off with here in the Newsonomics. We've got two of these stories up on freightwaves.com right now that I think are really topical and worth talking about in the context of what we're mentioning today. The first one being General Mills raises guidance after overcoming supply chain constraints. And this is written, of course, by Mike Bowden-Distel, our CPG expert, and also got that financial equities experience at Stifel from back in the day. So he knows what he's talking about when
he's a genius.
He's looking into all these things. He's not just our rail intermodal expert. He understands the equities markets as well. And that's the context with which this one is written. So some great takeaways in here, Anthony, and then I'll let you chime in. So the first thing that grabs my attention, they overcame supply chain hurdles. Mm-hmm. If you read in this article, it's not like they fixed their supply chain entirely. They just made improvements over the last bit to allow them, especially with some of their the pizza dough and hot snacks side of their business, showing some levels of improvement in terms of availability and management strategies there. They have offset some of their inflation, roughly 1% differential right there. Their costs are inflating at 8%, whereas they're taking some price increases on their goods at about 7%. So there's still a little bit of margin erosion there. But it is better than just straight off passing it along, which is what a lot of these companies traditionally would do until conditions eased a little bit to maintain that market share. And they're hedging. They're hedging their situation in 2023, 2022 to 2023, their fiscal year. They're doing various things to kind of offset some of these costs. They're not marketing goods that don't have as much availability or things that are already in short supply, because why would you need to do that?
Yeah.
That's wasted money, because why would you try to sell something you don't have?
Exactly.
And then, of course, they are spending capital to expand their manufacturing capacity in the coming year, bringing some production in-house, because they expect their demand to be sustained at a little bit higher level.
Yeah, and so I think, so that last part is the part that really kind of sticks out to me, is just that expansion, because we're looking at what shippers are doing right now, is that they really saw and realized, I think, throughout this pandemic that, hey, our facilities aren't up to par or not in a place to really handle what's going on right now. And so really trying to build out an existing space is going to be difficult. Sometimes you need to put up a whole new facility. Sometimes you need to expand and just kind of like, hey, this whole new segment is just going to be new, ramped up, and really kind of improved to take on some of these this influx of volumes that we're seeing. And I think that's where a lot of shippers, a lot of manufacturers are going to have to kind of take a look in the mirror and like saying, hey, what were our shortcomings throughout this pandemic?
Right.
How can we be efficient? How can we ramp up? Because all the warehouses that we're seeing right now may not be really in a good place right now to take on what we've been seeing. It's all built around, that just-in-time thought process,
which is near impossible to manage at this point. This article is really a microcosm of our current environment to me, because another thing they called out here, or Mike calls out here, is they've built up their inventory of raw materials and raw goods so that they don't have to rely as much on that just-in-time situation. So they've that just-in-case environment, especially with the Ukrainian crisis going on, a lot of uncertainty over the next 12 months around how long that's going to persist, because the longer that goes out and stretches out, the global supply of goods and commodities is really at risk here. I mean, we already see it with gas prices, and gas has a downstream effect on a lot of different goods and items. So they're building their upstream inventories, something Zach Rogers talked about last week with us. Go check out that episode if you missed it, because it's one of the best ones anytime he's on. And they are building out some long-term strategies to hedge against this type of inflationary environment in the future.
Yeah, and I think that's the big part of it, is hedging against that inflationary pressure. And really, the commodities, we were talking about this earlier this morning, it's difficult to forecast anything like that, because you have these events that can happen that can really kind of spike something on a week-to-week basis, and then it drops the next week. And I think when we're looking at what's going on in the world and what's going on with these underlying trends, what we're seeing right now, the slower growth, these were trends that were really kind of set in place months ago. So when we're talking about, looking at our expectations when we were in December for 2022, the expectations were, hey, there's going to be some slower growth. Like, we're expecting that. I think everyone's been watching, of course, consumer sentiment, consumer confidence, things like that. Hey, this consumer is going to hold up that much longer, but they have to keep holding up. And we're going to talk about some of those consumer conditions a little bit later on, like those initial jobs claims, last stronghold for those consumers. But the slower growth right now isn't going to be necessarily a something to fall out from the Ukraine-Russia conflict, but that could definitely exacerbate it depending on the length and the depth and how severe this is going to be. But really what we're seeing right now is really things that have been really in the works over the last few months here. Yeah,
it's really hard to put that long-term strategy into place right now.
Yeah.
Don't you think, Anthony? I mean, there's not a lot of things that we can actually consistently rely on at this point. I think making multi-year forecasts is a waste of energy at this point, honestly. As a person that used to make the budgets and forecasts, it was hard to do back then. Now I don't even understand why you would waste that amount of time. Like, it's hard enough to figure out what's happening 3 months from now, let alone 3 years from now at this point. There's just so much up in the air. We've got shippers changing their strategies, long and short term. There's just not a lot of consistency in the economy at all.
No, and one of the funny things is when we look at some of the data, we're looking at, like you said, seasonality. It's just it's just strange, and it's almost like expect the unexpected.
Yep.
Whatever you expect to happen, the opposite, and then you look at the results, and that's exactly what's happening right now. So definitely a difficult time. So that's why it makes it so much more important to look at that near real-time data set, what's happening as of now.
Yeah, you really do have to check it a lot more often than you used to. So let's move on to the next piece, which I think is still topical. This one is written by Eric Coolidge. He was on FreightWaves Now this morning talking about this. Certainly go check out that clip if this interests you. But basically, he calls out in this article, will exuberance for air cargo conversions create a freighter glut? Yeah. I think he stopped short of saying that, but I think the idea here is that because it's such a long run plan to convert a lot of these passenger jets to cargo freighters, that it takes such a long time to do that. By the time that they're done, you have to have almost overcorrected, in my mind, because we're already seeing it happen in surface transportation. This easing process. And if we pull up this chart on air cargo rates, we're not seeing it yet by any means, but this is just the Freightos Air Index. It's a global composite of the average price per kilogram of what it costs to ship goods on a freighter or belly cargo in a passenger jet, if you will. And we haven't seen a significant decline just yet, but looking at some of our tender data and some of the economic data that we're going to talk about later today, I think it's inevitable that some of that pressure, because air cargo is very, very commodity specific. It's got to be some high value stuff. We're talking about pharmaceuticals, electronics, and that sense of urgency is required to validate the extra cost for some of these goods. So unless the air cargo environment kind of brings down its rates, I think, because what we're seeing in trucking right now, the sense of urgency is just not there because they've got this inventory glut. And I think eventually that's going to bleed into these other modes.
Yeah, and I mean, this is something that we've kind of seen time and time again within the freight industry, where there's just like, hey, the getting's good, so many partner people enter, and then it's a perfect practice in economics of like so many people are going to enter until the margins are really kind of,
It's too much money, and you have to do something. I mean, there's financial investors out there. There's pressure from equity holders and stakeholders like that you need to grow, and you need to grow your market share, and you need to figure out a way to make sure this doesn't happen again. Although it's hard to forecast pandemics and the environment that we've had in the past. But I do think that there is some obviously value in, if you are committing to this, go ahead and commit to it, because you have to. I mean, this is that long-term investment stuff that you have to make sure that you're able to take on this practice and this type of investment when the cycle changes. And that's the forecast that's hard to do at this point.
Yeah, that's difficult to do. And like you said, it's one of those things where you want to put yourself in a position where you're just like, this is never going to happen again. And it's almost like, say you go through some really economic hardship. Say you go through a recession of sorts. Mm-hmm. Say you had a house or two, and say it was maybe mid-2000s, like 2008, 2009. You're like, never again will I be in this position. And so you can correct and make sure you're in a good financial standing, you're very, physically healthy, all this other stuff. But you could potentially, I don't want to say overdo it, but you could, say, hey, I am so kind of, changed by this moment that happened, that I will not, say I'm going to put all my funds into one specific thing and I'm going to do nothing but hoard cash.
Right.
And now I'm just sitting.
But you're losing money when you do that.
Yeah.
Especially in a high inflationary environment. If inflation's at 8% and you just have cash, you're losing 8% annually.
Right.
If it stays that way, of course. And that's really bad outcome, financially speaking. You don't need to talk to a financial advisor. That was free. But again, so I want to go ahead and transition into this macroeconomic discussion a little bit, Anthony. And I want to set the table with our outbound tender volume index and outbound tender rejection index first. So that's going to be our OTVI and OTRI chart here. Just to kind of, trucking tends to be a little bit more of a leading indicator of the durable goods economy and things like that. So what you're looking at here, outbound tender volume index, for those of you that aren't familiar, it's an index based on total tenders to shippers, or to carriers, I should say, from shippers. And the blue line there is the percent of those tenders that is rejected by a carrier. When carriers are rejecting more tenders, capacity's tighter, carriers have other options. Maybe they can't essentially cover all the freight. We've seen 20-25% tender rejection rates over the last year. This is dropping rapidly in March. We've dropped all the way from 19% in early March to 15.6%. And you can see in that trend line, in that blue line right there, it is accelerating. OTVI and the orange line there had some stickiness to it. And it looks like even as tender rejections were kind of falling, demand was still up. Well, now that one has followed suit here, and we're seeing some of this demand side stuff erode, Anthony. So tell me why.
So, Zach, I think one of the things that we are looking at here, I know we talked about a little bit earlier on the carrier updates and shipper updates, is some of the slowing trends that's happening right now. I know when we're looking at some of the retail sales, we had positive retail sales in this last report in February. Great, we want to see that expansion, especially after seeing, 4+% the month before. But when we're looking at what's happening within those retail sales, the subcomponents, we saw non-store retailers had a pretty significant decline. We saw furniture, electronic appliances all have declines. Where we saw upward movement was retail sales for gas stations. Some of these things where there's going to be a little bit more energy intensive. So when you take all those things out, it was either flat or negative, depending on which subsector you want to look at. And so when you're looking at the actual goods moving, there are likely fewer goods moving throughout the economy, and you can see that reflected here within some of the volumes happening right now. And to kind of have a little bit more of a further outlook to that, we got durable good orders that got updated just this morning, showing that there were even another downward movement for February for new orders being put in place. Now this is a forward-looking indicator, but it's showing that there is a slowdown for 1 month right now, but just 1 month showing that there is been a downward movement in those new orders, which will lead to fewer shipments and fewer production units overall. So that's just a leading indicator for just 1 month, but we are seeing that early signs that, hey, there was a peel back just as of the latest retail sales report.
Yeah, and we talked to Dr. Zach Rogers of Colorado State last week, and we saw that huge inventory build. They got traction for the first time since the pandemic started back in January and February. So, I mean, shippers are now seeing inventories grow rapidly. Demand looks like it's taken a little bit of a hit, not a huge one just yet, but enough of one. And there's also some concerning factors with the rapid inflation. When you're talking about food and gas inflating, I know normally we talk about it kind of independent of each other, but those are things that are going to erode all that disposable income that you were spending on electronics and things like that. It's going away. A lot of people are returning to work because the pandemic, for now, is kind of waning. And that's going to reduce their time and availability to spend money on these goods. Like there's multiple societal shifts and changes going on right now that it's going to help reduce. I mean, it has to reduce demand for the consumer products, right?
Yeah, and I remember I joked about this a few months ago, where I'm like, you know what, I'm kind of okay where if get to a point where consumer demand just kind of gets eroded because we need to catch up in the supply chain. But when we're looking at, I think you used the word waning, I think that's the right term for it, because we'll see a stair-step approach for a lot of people when they look at, the choices that they make, instead of, hey, maybe fresh off of stimulus checks in 2020, instead of like, hey, my phone's being a little bit funny, after stimulus check, I'll just get a new one. What's the latest one out? Give it to me. Now, you might think of, hey, my phone's getting a little bit funny. Maybe I'll fix it. Do I get a new one or do I get it, repaired?
Well, they can't drive to the store to get it repaired anymore because it costs $5 a gallon to fill up. And that's a double hit right there. Like, say you return to work, now you're spending more money on gas because you are just traveling more, and now gas costs twice as much as it did.
Yeah.
That's a double dip into that pool of funds. Now, gas prices tend to have a longer run hit to the economy. They normally like kind of show up back in America, in the American economy later down the line. What I think you don't want is this huge spike in anything. You don't want a huge hit one way or the other. That quick volatile change is really what causes some of that pain, right?
It does, and then it starts to play on the mind as well, where you're just like, all right, this is happening right now. And even if it comes back down, there's this mind shift of like, no, I'm paying more here, I have to pay less here now, or I have to really save here. And I think that's where that mindset comes in of like, hey, I won't buy a new unit of whatever it might be. I'll look to get this unit repaired, or I'm going to hold off on these repairs. And that could be for anything. I know I used an example as a phone, but it could be a house. You know,
right.
Home prices are, continuing to go up. We're going to see some interesting developments, I think, throughout the housing market as we continue to go into the spring. But maybe if I do have a home, maybe I'm looking into, remodeling. And that was one of the things that we're looking at, last year when inventories were so low. Now, inventory is a little bit better, slightly, but now we're seeing, lumber is not inexpensive. It is going back up once again. So now you're going to have to kind of question, hey, is this remodeling, project worth it right now? Where do I go from here? So there's going to be a lot of questions where you just kind of, hey, I'm going to take a step down. I'm going to go to this luxury dinner, maybe I'll go to this mid-luxury meal, or maybe I'll just get, the drive-through or takeout, things like that. And so I think we'll see consumers really start to peel back slowly but surely on certain decisions that they're going to make.
Yeah, and I think we're seeing a peel back in the consumer side, really. I mean, it's really a downstream impact. I mean, the freight market itself, you could see the connection. If you pulled up the consumer expenditures chart and put it next to OTVI, that's what was propping up the freight market when we look at those tender volumes going up. So I think you can, with a safe assumption, say that a lot of that is probably on the downstream consumer side. Now, I want to pair that a little bit here. We've talked about flatbed rejections going up. The housing market is still strong, industrial sector, manufacturing, et cetera. I want to pull up our import demand, our IOTI, to kind of show we've got another side to this equation here, that demand is not necessarily gone all away. It's a very bifurcated response here in terms of this is our IOTI, which measures bookings, import TEUs coming into the United States from all over the globe on the ships. TEU index is still up, Anthony. People are still bringing goods in, and we talked to Zach Rogers about this, and he said a lot of this was still upstream. They're holding a lot of this stuff upstream. And I think some of this erosion is happening on that downstream side. I think you got a complete 100% accuracy on this one. What do you think?
Yeah, and then I know we're looking at inventory levels through the roof, literally, pun intended. And so when we're looking at that, inventory levels going up. I know it's had the highest reading that we've had in the LMI history. We're seeing warehouse prices go up as well. So this puts those shippers in a very difficult position where it's just like, hey, is it going to be worth pulling these goods in? And now that they're in, I gotta shuttle this stuff off. I gotta get it out. Like, this stuff has to move. And this also gets concerning to me, Zach. This is going to be a little bit of a shift in a different direction because we're seeing a lot of this inflationary pressure because there is just so many supply chain disruptions right now. And that's just the fact of the matter.
And just like with General Mills, we were talking about, they're building their inventory of raw goods and raw materials. And I think that's a lot of what's keeping this IOTI up, is people are now starting to hoard things. It's kind of like the trade war in 2019. It didn't necessarily translate immediately to the surface transportation side. Now you see this hoarding impact. And while they're building out their factories, they got to build up some stuff so they have it just in case. I think that impact is still there. And that's what we're going to see probably for a while.
Yeah, it's definitely still there. And the thing that makes this really interesting, I think, is the movement from the Federal Reserve. So we hear from Jerome Powell, who brilliant economist. Of course he is, if he wouldn't be if he wasn't in that position, or he wouldn't be in that position if he wasn't one. But one of the things that he mentioned is that, he notices and noted that, inflation is just way too high and the Fed will take necessary actions. My fear is that because this is I think, supply chain-led inflationary period, of course, with the infusion of cash, interest rates might not be the right tool, although it does need to go up eventually. is it going to be the right tool to combat this style of supply chain inflation? So
the question of the year right there.
Yeah, and so I think that's going to be it.
We have things that are naturally going to correct it. The fuel, food, all these inflationary pressures naturally correct over time. Does the government need to get involved? I guess the Fed's not the government, but
that's another show.
Another show altogether. Well, I mean, to me, this is a very disparate. We're still in a very divided recovery process. The upstream people are going to have a very different impact or experience than the downstream folk. I think we're actually seeing a lot of this downstream stuff show up first, though.
Exactly, right. And this is the end of the show. I got to give a shout out to Jason H., who had a comment that we weren't able to get to just yet. But thank you so much for chiming in, talking about customers and carriers out there and rates and bids for yearly prices.
Oh, man.
Jason, that could have been a whole nother topic. But thank you guys so much for tuning in. This is Freightonomics. Drink more water.
Yeah, have a great week. And, man, good luck out there. Things continue.